is CYH. Good morning. 6:08 a.m. 4/12/2011. Earnings season kickoff. GSK. I wonder what that is. Up 34 cents. But here's the gap up list on the NYSE. Once again, and all pre-market, you have a diminishing gap up list. It's not a long list, just like for the new people here, the new MMTs. You don't see an expansion in the gap up list, but rather a contraction. The penny gaps don't mean anything. CYH up 2.78 will be a short. It'll put in the intraday high and it'll slide the bid. ZNH 1.43. SKH 1.35. CEA. These stocks right here are the ones that there's got to be some kind of news related. The gap sequence, when that buyer or the short seller buys the cover and puts in that interim top, slide that bid. Gap open down list. Notice that the gap open down list, PTR, WMS, IDC, CEO, all of these stocks, they're all over bloated. So that bull and that CMG, we're short. We're short some of these names. But here, look at the list. The gap down list on the NYSE has expanded. MCP, we made great markets on that. That's a new market maker edition. Of course, we cover so many of them. BHP Hilton, Rio are two of the names to watch during this pullback. And the left elbow in that BHP and that IRO. Potash, I mean, this NYSE list, look at here. This thing is long in depth in the tooth. Because it is. The gap open up again, very diminished. There's a mathematical imbalance between the two. My friends, these are all left elbow gap downs. One thing about the left elbow during the earnings season is you better make sure on that left elbow that there wasn't a quarterly miss or a guide down, because on the first pass they're always tradable for a shorter term profit, but you're not going to get all day. And 60% of your institutional program happens right here on the NYSE. The transports are not going to be helping the overall indexes. The financials would have to replace it. We are short a lot of transportation stocks. We've been building them. We went through the first correction, and then we took these indexes down and we called the top. It's on the stockmarketplanning.com homepage before that move even happened. Now, we've gone through both the bear and the bull, and so we had a big, in that first quarterly trade of the year, which is 2011, I'm sorry, January, February, March. You're in the second quarter now of the trading, April, May, and June. But here, let me just tell you something very quickly and very nicely. Discretionary income is going to be spent in a different way. We're not going to talk about that today or in this particular gap up and gap down list, but it will be contracting, and we'll talk about how that all looks. Of course, it's everything you've already been told for the people that were here in 2010 and this new group in 2011. You were told it all before it happened. Talk is cheap. Truth tells it. Talk is cheap. Pre-market, every day before the markets open up, the trade management's 100% accurate. That is truth. Can't find that other places. Go find it. The bull's been in denial. We know. Short overvalued, buy undervalued, with pair trades. The outperformers in this quarterly earnings cycle, and we'll do this in a different video altogether about these earnings cycles today, as we just started with Alcoa last night. Trade management is Cleveland Cliffs, some of these commodity related type names. Take a look at them, put them in there and watch them in your market minder. because she will give you voice alerts and she will teletype you as to what they're doing. They're going to be the ones that move off the bottom. That MCP, stay on it. Remember, on a day, off a day, and there are some days you have more relevancy in price action momentum off of the left elbow gap down. They're all tradable. The thing about it is they're shorter distance, but they're all profitable trades. You're just not going to get as much yield in the trade. That's all that is. So watch these high flyers. Watch these in this index, because it's going to be the Rios. It's going to be the BHPs. And the reason why this list is so much longer is because that bigger money on the NYSE is going to do this, the bigger tier level, not the little day trading community. They're rat crap. They don't even have no volume in the market. The bigger tier level, the hedge fund managers are hacking each other, whacking each other. Tier 1, Tier 2, Tier 3 institutional levels are going to be selling and competing for that yield, that profitable trade. Meaning that in correction number 2, we've already gone through 1. Number 2 will be much worse than number 1. That's where the stage 4 of the original correction kicks in, as you have been taught wholeheartedly and 100% accurately of both the bear reversal in February and the bull move off the bottom. It always happens that way in phase 1. But let me tell you something, there's a rude awakening around the corner. And guess what? Stay tuned. Trade management, roll up, roll over, Beethoven.